Welcome to GRE. Why don't stocks create wealth? After answering that, learn about some trade-offs between long-term rentals and short-term rentals and the pros and cons of getting a construction loan and new build rental properties today on Get Rich Education. GRE listeners can't stop talking about their service from Ridge Lending Group and MLS 42056. They've provided our tribe with more loans than anyone. They're truly a top lender for beginners and veterans. It's where I go to get my own loans for single-family rental property up to 4plexes. So start your pre-qualification and you can chat with President Chaley Ridge personally. They'll even deliver your custom plan for growing your real estate portfolio. Start at ridgelendinggroup.com. You know, a lot of investors choose either cash flow or home price appreciation, but one real estate market could provide both: Jacksonville, Florida. They've got 27% lower home prices and higher rents than the national median. Their market has appreciated 34% more than other comparable cash flow markets over the last 30 years. Get positive cash flow today and above average appreciation for tomorrow. They often have available inventory in Jacksonville, if you can believe that. Start at cashflowandgrowth.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Hialeah, Florida to Haleakala, Hawaii, and across 188 nations worldwide. That's almost all of them. I'm Keith Weinhold. This is Get Rich Education. I find it interesting that there are still smart people out there who think that stocks create wealth. Like, everyday people could create wealth just by investing in stocks or mutual funds or ETFs. I'll tell you, I have never met anyone in my entire life that has become wealthy from investing in those vehicles. Now, that's something that should not offend stock adherents, because that has been my personal experience. And then just asking around here at GRE a bit, I found out that our content manager, Matthew, he said that he once knew just one person that did get wealthy with stocks, and that is because that person's company IPO'd. Okay, well, that's worth knowing. But as for everyday investors, what one might call a retail investor, an everyday person that buys and owns Apple stock or Amazon stock through E-Trade or Robinhood or TD Ameritrade, or they bought the S&P 500 index fund from a big mutual fund company. I mean, do you know anyone that's ever created wealth from stocks or mutual funds that way? Or do you even know anyone that ever knew someone that created wealth with stocks? And I am talking about creating wealth here. Okay, for example, someone that started at a level of perhaps just getting by, and then they went from there to becoming wealthy with stocks. Or even someone that started at a level of middle class and then transitioned to wealthy simply through shrewd and savvy stock investing. I think a lot of people invest in stocks just because it's easy and that's what the herd does, but they never ask themselves at all, have I ever actually met anyone that's created wealth from stocks? And if you run with a herd, by definition, you don't get ahead. So why is this? How come virtually no one gets wealthy with stocks? Well, look, we all learn and understand the world through different lenses, and I'm going to share the thought paradigm that shifted my own personal journey here, and why I have not personally, or in any way, not through an LLC either, owned any stock or mutual fund or ETF since the year 2014. All right, right now, major stock indices are flirting with bear market territory. They did have quite a run-up before that. But bear market territory, that means a value loss of 20% or more from a recent peak. That's how that's defined. And recently, the Dow Jones posted its 8th straight weekly loss, and that is its longest weekly losing streak since 1923. Could we then say that misery loves companies? Big tech has shrunk to medium tech? Even staid reliables like Apple and Target and Walmart are tanking. Now, other than a 1-month virus flash crash in March of 2020, a lot of millennials and Gen Zers, they have absolutely zero experience with what I'll call a sustained bear market. We haven't had any of those occur for 13 years, which is an unusually long time historically. And perhaps some of these investors will sell low and maybe they'll stay the course. Now, investing in the stock market is so common and so herd-like that if you're talking just in a general conversation, if you're talking with someone else and another person refers to the market, they just say the market in a sentence, well, everyone just assumes that you mean the stock market. Well, shouldn't, quote unquote, the market be creating wealth for people if it's such a topic of conversation? Or if you just say the market, people know what market you're talking about? I mean, after all, the S&P 500 has averaged a 10% annual return over time. That doesn't sound too bad. And in order to emphasize compounded returns, one thing that traditional old school advisors often cite is the rule of 72. They often refer to that. You've probably heard of it. What you do is take the number 72, you divide it by your annual percent return, 10 in this case, and that's how many years it would take your money to double. So therefore, an S&P investor should double their money every 7.2 years. Well, that sounds pretty good to most people. And then over the decades, several doublings, well, that should ensure at least a fantastic retirement and maybe even a taste of wealth. But then why doesn't it? Why doesn't it provide a fantastic retirement most times? And why doesn't it put people on that wealthy echelon pretty much ever? This is due to 5 chief drags: inflation, emotion, taxes, fees, and volatility. And I've glossed over that before with you, but let's go deeper now. Let's see how this all negates out what so many investors think is some kind of good return with stocks. What we'll do is we'll subtract each one of these from this 10% unadjusted stock return. All right, let's go. This is what we're starting with, a 10% unadjusted stock return here. With the first one, inflation. Well, a lot of experts agree that the CPI, currently 8% plus, that understates the true rate of inflation. It could very well be 12 or 15% or more right now. But let's just say that long-term true inflation averages just 5%. Yes, you could make the case that it's more. We'll just use 5% inflation. Well, then your long-term 10% stock return minus 5% inflation equals a 5% inflation-adjusted return. The next drag is emotion, and everyone knows that you're supposed to buy low and sell high, but a lot of people do the opposite. And why is that? Because it's really difficult to do in practice when you're in the moment. See, one has difficulty buying low because when prices are low, prices have often fallen over a long period of time before the dip. So the predominant emotion is one of discouragement. When stock prices have gone down, much like they have this year, so many people get emotional and they end up selling low. And, they justify selling low by telling themselves something like, I am just so sick of losing money. And you know what? If I sell, the one thing I do know is that it guarantees that I'll stop losing money. So many people do sell low. And then on the flip side, well, what about when the market's high? Why isn't everyone selling high? Well, that's because prices have grown. It's hard to sell out of upward momentum. When prices are going up, and your friends are making money and you want to get in if you're even somewhat on the sidelines, you've got FOMO, fear of missing out, and the emotion is euphoria. This is what makes people buy, maybe not at the very peak, but they often buy higher than what they sold for, which is just the opposite of what they're supposed to do. And despite all of this, most people actually believe that they are above average investors despite that statistical impossibility. That's an effect that's actually known as illusory superiority. Yes, there is a name for that, but it's really the effect of like how 7 out of 10 people believe that they are above average drivers. Again, that's a statistical impossibility. People feel that way about their investing ability too. So people often sell lower and buy higher. So now that we've got this 5% inflation adjusted stock return, let's just take it down to 4%. And again, that is being pretty kind to only knock 1% off our return. Then let's factor in the effect of taxes and fees. Well, long-term capital gains taxes start at 15%. The highest ordinary income tax rate is 37%, which is the equivalent of the short-term capital gains tax. And those percentages, that's what gets taken out of your profits. So those percentages eat into that entire 10% return that we started out with here. And even if your funds are sheltered in a 401k or a lot of retirement account types, yes, you could get tax-deferred growth, but you must begin paying taxes in retirement. And then fees, we're not going to get into that because that's something that varies widely. So an S&P 500 investor's return, after it's adjusted for inflation and emotion and taxes and fees, is often below 2%. It could very well be far below 2%. And we're not done here. The last one is volatility, this last drag. And so many people miss this. The rule of 72 and other projections are based on a fixed annual interest rate, and that is called the compound annual growth rate. Sometimes, if you get into some wonky material, you'll see this abbreviated as the CAGR, the compound annual growth rate. Well, in our example with this rule of 72, that assumes that you get an exact 10% return every single year, year after year, which is irresponsibly quixotic. The real world does not work this way. Let's say that a price falls 20%, which again is a bear market. Well, now you must gain 25% just to get back to even. That is simply math. And if a price falls 40%, it needs to gain 66.7% just to get back to sea level, just to get back to even. So using a smoothed compound annual growth rate, CAGR, what it does is that diminishes the damaging effect of return volatility. All right, so let's take our 2% return that's already been adjusted for inflation and emotion and taxes and fees. And now what happens when we subtract out this volatility? Now you see why real rates of return are often less than 0% for stock, mutual fund, and ETF investors. Maybe they're minus 3%, maybe they're minus 12%. Real stock returns often crumble faster than a Nature Valley granola bar. And Nature Valley granola bars are not good for you either. They're full of sugar and canola oil. A lot of processed food there. Now, note that I even used what a lot of people consider good times in my example, where we started with a 10% unadjusted return. This is an audio format here on GRE Podcast episode 399, so my analysis wasn't deeply technical and it wasn't replete with formulas for pinpoint accuracy. You might remember we had Garrett Gunderson here on the show a few times. He really goes deep on how stock and mutual fund investors typically lose prosperity year after year after year. And Garrett said on one of those shows, he thinks I'm being kind when I say that a stock investor's real return is as high as 0%. So this all helps you begin to understand why you rarely, if ever, met anyone at all that acquired wealth with these type of vehicles. About 10 years ago, while I was working for the State Department of Transportation in an 8-foot by 10-foot blue cubicle, I began to realize a few things. First, I realized that investing in retirement plans makes me safe and normal, and I don't want a life that's safe and normal. That's not extraordinary at all. I also began to realize that every dollar invested in stocks and mutual funds is a dollar that cannot leverage other people's money. I started to realize that retirement plans provide zero income until I'm old, and I started to realize that I will not get ahead by following the herd. So yeah, that was about 10 years ago that some of these things really began to crystallize and became cathartic for me. And then later, I interviewed the actual man that invented the 401k plan, Ted Benna. And Benna told me directly that the plans don't serve people the way that they were intended. And by the way, my interview with Ted Benna, that is recorded. You might remember that episode. That was GRE Podcast episode 197, in case you haven't heard it. Yeah, the guy that actually invented the 401k in the late 1970s. That's right here on episode 197. So now you understand much of why I haven't owned any stock or mutual fund or ETF-based investment at all since 2014. And this show is called Get Rich Education. So I really could talk about anything related to wealth building and still stay on point. But now I think you understand why I don't discuss stocks very often here. And it should be noted that real estate has some drags too. For example, investors often underestimate their maintenance and repair costs. But ultimately, the fact that real estate pays 5 ways at the same time, that's why it's superior. That's how anything less than a 20 to 25% fully adjusted rate of return is disappointing. And because real estate is an illiquid asset, this acts as a healthy barrier against panic buying or against panic selling. And illiquidity then diminishes the deleterious effects of emotion and volatility. I do know investors who have created financial freedom through real estate, a lot of them, and I'm one of them. And really, if I can distill it down into one word for you, the short story about why I've met countless people that have graduated from middle class to wealthy through real estate is leverage. Leverage is that one word. And some of this is natural bias because I do hang out in real estate circles. I do just tend to meet more of these type of people as well. To stock investors, leverage is something that's only available to more sophisticated types. And even then, it often comes with margin call risk, something that you don't get in real estate. And with stocks, leverage is in a more limited measure than its wide availability in real estate. Now, bear markets like we have right now in stocks, what that does is it makes people reevaluate things. So to a younger investor that's potentially experiencing their first sustained stock bear market now, it's important to understand that generally stocks are not a game designed to build wealth for everyday people anyway. Times like these make people revert to fundamentals. Ultimately, your success as an investor hinges upon your ability to provide others with value. Be a person of value in the world. There have been few times in modern history when owning real estate demonstrates more intrinsic value than it does today because you're providing others with housing, and that's something that's increased in usefulness now and is historically scarce in supply. At the same time, wealth comes down to your ability to be valuable. When it comes to residential real estate, there are so many ways that we can segment it. Later on today, we'll discuss new build properties versus existing properties and what's going on in those markets today. We can also parse the space with long-term rentals versus short-term rentals. And when we define that, of course, as the name would allude to, that is based on the duration of a resident's stay. And depending on the jurisdiction and more, a rental period of under 30 days could be considered a short-term rental. Some people refer to these as Airbnbs or VRBOs, or even up to lease periods of less than 6 months could be considered a short-term rental. Now, long-term rentals have more predictable long-term income, and one big part of that is because a tenant often signs on for a lease period of 1 year or more, and long-term rentals are also deemed to be more recession resilient. Short-term rentals have lower occupancy than long-term rentals, but because the daily rate is so much higher in short-term rentals, they can be more profitable than long-term rentals. And when you look at any investment, it is so fundamental for you to understand who you serve. Who is that customer that you serve? Back to my point about stocks, it helps you understand how you can be a person of value. Now, in long-term rentals, you serve families and roommates and what you might call everyday mom and pops. Until just 5 years ago, short-term rentals principally served two groups of people, vacationers and business travelers. And with what happened in the world starting in 2020, the short-term rental community was concerned that the business traveler would go away and not come back. But it didn't seem to matter that much because increasingly over the past 5+ years, you have more and more of these digital nomads and work from anywhere types that rent short-term rentals. For long-term rentals, oftentimes properties make sense in the Midwest and South, somewhat away from the city centers. And then short-term rentals locations are often resorts and beach communities and ski areas as well. Homeowners association limits are something that you have to be more wary of with short-term rentals. They're more likely to crack down on that activity. And in short-term rentals, oftentimes you need to charge a lodging or a rental tax to the resident. And you also do get to charge the resident with the cleaning fee in a lot of cases. Property management costs for long-term rentals, they tend to be 8 to 10% of each month's rent amount is what you pay. And then in short-term rentals, you often pay 20% or more in a management fee. You lose 20% or more of your rent there because there are more resident turns and more advertising and listings to manage. When it comes to financing, you'll often find long-term rentals have better availability that way than short-term rentals. And this is huge since leverage is what really creates wealth. When it comes to damages that a tenant might do, short-term rental tenants pay up front, and they usually place a credit card on file to cover any damages. So there is some more protection that way. And overall, one great piece of real estate investing guidance is that the best short-term rentals are those property types where if that short-term rental market drying up, you could fall back onto that same property and use it as a viable long-term rental. To summarize what you've learned so far today, the definition of a bear market is when a market has lost 20% or more of its value from a recent high. Stocks don't create wealth due to inflation, emotion, taxes, fees, and volatility. And a lot of people miss that until it's too late in nearly retirement time, when they thought they could retire and they can't, and that long-term rentals and short-term rentals have a lot of trade-offs. Long-term rentals are easier to finance and have more recession resilience, and short-term rentals can provide more income when it's dialed in just right. Long-term rentals have the longer track record. Coming up, a guest and I are going to discuss today's opportunity on brand new construction rental property. That's straight ahead. I'm Keith Weinhold. This is Get Rich Education. For accredited investors, if you've ever wanted 10 to 12% passive income returns, Wagner & Alasko and his professional partners could have the right answer for you with real estate, one of the safest assets available on the planet. On a preferred return basis, you collect your money before anyone else does. I encourage you, go ahead, learn more about their opportunities at I'mAccredited.com or text 305-684-2222 for your free investment guide. Hey, my friend Damian Lupo informed me that checkbook IRAs have been made illegal by the U.S. tax court. If you have a checkbook IRA, your holdings are now disqualified with taxes and penalties up to 50%. But don't panic, Damian and the eQRP company can fix this. Those IRAs can be converted into eQRPs retroactive to last year, getting those tax deductions and reducing your taxable income. In this way, you can invest your 401k or IRA in real estate, Bitcoin, gold, and even your own business. So whether you're a full-time investor or retired or even a dentist with dozens of employees, if you're listening, you qualify, the eQRP works. It's the solution. You'll control your money, kill UBIT, and pay way less taxes. To learn more about this strategy and free up your retirement money, get the newest eQRP special report. Text GRE to 307-213-3475. That's text GRE to 307-213-3475.
This is Rich Dad Advisor Tom Wheelwright. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
I'd like to welcome in someone who is becoming a real friend of the show here, Zach Lee Master. He's a seasoned real estate investor and licensed broker, and he's amassed quite a large portfolio of rental properties across many markets with single-family, multifamily, commercial, and new construction. He started investing in real estate while working as an optometrist and captain for the U.S. Air Force, and he's been a real success with becoming a financially free real estate investor because this allowed him to retire early from his career in medicine to be a professional investor focused on cash flow and appreciation. And then he went on to build a successful wholesaling, flipping, and management business working across multiple markets. And amidst all that, he's still a licensed optometrist who practices on a volunteer basis. Quite a story there. Zach, welcome to GRE.
Keith, thanks so much for having me. Excited to be here. And what a nice intro. I appreciate that.
Zach, yeah, you've had such success in the business, and we often see trends as the business changes. 12 years ago or so, America was in an oversupplied housing condition. Today, we're in an undersupplied housing condition, and we've really had the advent of this build-to-rent space that really can offer something good to long-term real estate investors with these properties that are brand new on day one and built with the tenant in mind. I know you deal with those properties a lot. So from your perspective, tell us more about build to rent, which is almost a movement in the rental space.
Yeah, I love it. We're really partial towards new construction in general. We love new construction, Keith, just simply because we operate a lot in the turnkey spaces as well, where we have properties that are older, renovated, leased, and managed. However, a 1950s house, it's still a 1950s house, even if you do a full renovation, you know what I mean? So now you can be in a great neighborhood and things like that. But one benefit of having new construction and participating in the build-to-rent space in particular is just the benefit of having a brand new built house that will attract the best quality tenants. Usually you have longer occupancy times with less vacancy. You obviously have builder warranties. I think the key point of really what makes that a successful endeavor and asset class is investing in the path of progress in the markets that have a huge undersupply and have a huge demand. So some of these would be on the Sun Belt, different parts of Texas and Southwest Florida, absolutely. Well, really throughout all of Florida, Alabama, Carolinas, areas where there is a mass amount of people moving. And to your point, Keith, there's just a shortage of housing. And so often what we've seen is there's a wait list for tenants. Once the house is completed, the construction itself, based on the market, just how we've seen the market evolve over the past few years, you're likely entering into quite a bit of equity. And rents are going up dramatically. And so we really like the build to rent space because it's an area that you can come into immediate equity. You can have strong cash flow, which is typically hard to do on new construction. We've done new construction for many years in different parts of the country, and it's generally hard to cash flow. So you get to have a little bit of your cake and eat it too in this scenario, as long as you're patient. That is the one aspect that I would say you just have to be a little bit patient to wait for the house to be completed, simply because in today's market, supply chain and everything else going on, it takes a while for the construction to be completed, but I think it's worth the wait. So that's why we like the build to rent space.
Build to rent, that starts with build, and one can build on either an infill space where there is one independent lot with structures already built around it, or one can build on contiguous lots altogether. So can you talk to us about some of those trade-offs in the build to rent space, infill lots versus building on contiguous tracts?
Typically, where we've been the most successful is more or less like an infill type of setting, especially in areas where there's housing going on, but they're not tract homes. This isn't a community development in particular. You see a lot of larger builders, national builders like Toll, Lennar, D.R. Horton. Some of those builders are coming in and buying up some of these large places and parceling out the land and doing the whole development structure. While we have participated to that capacity in some degree in the past, it is hard to compete with those national type of builders. So if you're in an area where there's high rental demand and there's still availability for land on an infill basis, that's an area that we really see the most opportunity and where we participate the most. So, you purchase the land and it's already pre-parceled out. It may have some surrounding houses and structures, and you can build there. In a very densely populated metropolitan area, a kind of another version of this that we've seen is a scrape and build. There's builders going into these areas that have older homes and just buying them, demolishing the older house, and then building a much larger, more expensive house. That's not an area we participate in, but kind of similar area.
Some of the advantages are with build to rents on contiguous tracks, kind of nice. All the amenities are new, roads and drainage and maybe parks and lighting and other amenities and everything else. And then with infill lots, the advantage there is you don't have to wonder what's going to be built up around you because it's already been built up around you. And we think about build to rent. Oftentimes over the long term, we think about appreciation rates on a new construction build to rent property versus renovated property. And to your point about appreciation earlier, we've seen so much appreciation lately just by virtue of the fact that a property is in the United States, no matter what type it is. But can you talk to us from your vantage point about the appreciation rate that you've seen in these build to rent new construction versus renovated? And then what investors are doing while they're flush with equity?
It's definitely a time to be a aggressive and strategic investor. And there's a lot of moving parts right now, but this is one thing, Keith, I actually listened to you speak about recently is our 40-year high inflation and, higher interest rates increasing over time. There's a lot of people wondering, what am I doing? Stock market and crypto is all over the place. So there's a lot of people that are wondering, what do? You got to invest in real estate to some degree, especially something, a hard asset that outpaces inflation. So, but I won't get on my soapbox in particular there. To answer your question, appreciation with new construction in the right locations, it's just been astronomical as of late. I mean, the past year in most parts of Florida, we've seen a 29% appreciation in home prices just over the past year. Land has tripled in price. It has become less available. So, I mean, you haven't missed the boat, though. There's still opportunity. We still have every reason to believe that trend is going to continue for this next year, just based on supply and demand and population trends. We've seen a 22% increase in rents. So just to use some real numbers, the 4-2 model that we really like to build in Southwest Florida, that's right around that $300,000 price point. That's appreciating very quickly. But even at today's market value, Keith, those are appraising usually in that 380 to 420 range. So it's quite possible. And that's today's market value. If that house was completed today, now it takes, maybe 14 to 16 months to complete it. And of course, in the future, we anticipate that it'll be worth more. But what that means from an investor standpoint with that much equity is you can be very creative where you can do a cash out refinance and pull likely all of your money out, if not most of it, to then reinvest and steal cash flow because those rents are still in that $2,500 a month range plus. Or you can sell the property. Of course, you'd have capital gains. Maybe you hold it for a year and then sell it in 1031. But I think the main point is it's a great opportunity to come into immediate equity where you can be a creative investor to obtain a higher return on your investment and scale your portfolio faster. That's what a lot of our investors are doing. And us personally, we've had a lot of houses that we pulled more money back out of now that they're completed than we actually had down into the deal. And they're still cash flowing a double-digit cash on cash return. So I think it's just the nature of the market right now, being in positioning yourself in the right places and taking advantage of that opportunity. It won't last forever.
Yeah, it surely won't last forever. There's no guarantee about what's going to happen in the future. But while we've got this above average appreciation continuing, we ought to discuss it. And oftentimes this is attractive to a person that can weather and be patient in that build to rent process. Once that investor gets a build to rent property under contract, can you talk to us more about that process with some of the patience that it might take while it's being built? They might have an interest rate lock that they're concerned with at the time. And then the reward at the end with this potential for there being an appraisal for substantially higher than what the contract purchase price was for, hence the immediate equity.
It's quite a process. I mean, really what we're talking about here, the reason that investors able to obtain that immediate equity is because they are participating from the ground up. There's obviously no reason for any builder or investment group to sell a property below market value if they can just go and sell it retail. So if they're holding the financing, and we do this as well, some of our builds, we will sell retail at full market value because we're holding the financing. We're going through the entire process. Whereas an investor that wants to be a little bit more active, now, albeit there's a little bit more steps involved, a potential risk, but also better reward with that equity potential, they can actually participate from the ground up, meaning they're selecting the lot, they're actually buying the lot with cash, and they're taking out the construction financing themselves to actually finance the build. This would be similar to if someone's done a custom home build to some degree. So this is how they can participate from the ground up and actually build in their own equity position. The process basically, Keith, is that someone identifies, the builder that they want to say, if you're investing with our group, since we're partners doing this kind of collectively. If you wanted to invest with us, obviously get in touch with your GRE investment counselor and advisor, and they'll walk you all the way through the process. But the first thing that you want to do is get pre-approved with a construction loan. Many people are unfamiliar with what construction financing looks like. There's many options out there, and we have excellent lenders available. But the first thing you do is get pre-approved, just like you kind of would for normal land or a normal investment purchase. And then we guide you through the whole process of you buy the land. So you own the land outright. That's counted as part of your down payment towards the construction financing. And then once a house is built, probably takes about, I want to say 14 to 16 months right now, ground up, because nothing's been done to the lot yet. Once a house is completed, then you have some choices to make. You can sell it retail. You can do cash out refi and put your long-term debt in place. Maybe that's regular Fannie Mae, Freddie Mac loans. Whatever you want to do at that point in time, and you pay out the construction loan that is typically due in 18 to 24 months when the house is completed. And then you can hold it as a long-term loan in place. Throughout the entire construction process, this is where our team really is the experts in how to navigate through that process. There's a lot, and I don't know if we need to go into those details today, but permitting and surveys, design, once we get permits approved, which typically takes about 6 months in today's environment in a lot of locations, then the actual construction itself probably takes another 5 to 6 months. So that's kind of the timeline that we're looking at.
Okay, we're talking about if an investor wants to go that route, those being two separate things, a construction loan, and then at the end of the construction phase, paying that off, transitioning into a purchase loan.
Exactly. So that's going to be your long-term debt in place. So, their construction financing, there's all sorts of different terms out there. We have plenty of different lenders that basically require 20% down, so 20% equity, just like you would buy a normal investment property with conventional loans. But the construction loan, it's just financing the build. So the builder's taking out draws as they complete the build process. And that's the checks and balances that's important for you to have in place as the investor to make sure that the builder's meeting timelines, building the property to the right parameters and requirements and city regulations, and then they'll release the next draw. You're absolutely correct, Keith. Once the house is fully completed, you pay off the construction financing with either another loan at that place, or if you decided to sell the property.
During the process of that construction loan, the contractor often getting those intermittent payments. The foundation milestone is done and gets paid. The framing milestone is done and gets paid, et cetera, as part of that construction process prior to that converting to a purchase loan, if one so chooses to go that way. Can you talk to us more about the advantages and disadvantages of doing that? Because to some people, that just sounds like a whole, maybe even a mess to get involved with in those two loan types, rather than just going directly to a purchase loan for a build to rent property. Can you talk to us about that?
And that's kind of what we were alluding to earlier with this you don't have to do that, right? You don't have to take out a construction loan and go through all those steps. I would say as far as on the lending side, it's basically the same information and same work that a regular Fannie Mae investment loan would require of you. But the benefit to doing that is building in that equity. There's also the option to just put a deposit down. This would be typical of any national builder, right? You go in, you sign a contract for a property, you put deposit down, whatever that is, you let the builder build it. You're financing on the back end once it's actually completed. However, you're probably not coming into a significant amount of immediate equity when going that route. Now, one caveat that I'll say, Keith, is that there are some different loan products out there as well. Since one common concern would be, okay, well, where are interest rates at in a year from now? What if I don't want to wait for that? Well, there are different things you can do. There's construction to perm loans where you can lock your interest rate now. You can also pay for a 12 to 18-month rate lock if you want. There's ARM products as well that have lower interest rates. So without getting too convoluted, basically, I just want to mention there are different options for people. The best thing you can do is explore what makes sense for you and what meets your goals with all the different options out there in the build-to-rent space, because there are quite a few.
Now, the build-to-rent space is maturing. From your view, what do you see investors doing with their build-to-rent properties after they've held them for a number of years, especially now that we're in this high appreciation environment? So we're talking about the outcome of this maturity of the build-to-rent environment for an investor. And this is a conversation we would not really have been able to have had 10 years ago, because 10 years ago, we didn't have a significant amount of experience of investors in the build-to-rent space. So talk to us about that hold process, how that looks for an investor with build-to-rent products, and then the exit strategy after the hold period.
It's interesting because a lot of investors go into it thinking, I'm going to build this portfolio and hold it for 30 years, pay it off, which is quite possible, especially when you have a brand new built house. You don't have capital expenditures in the same time frame that you would with an older renovated house that might have some deferred maintenance. So in general, Keith, we see holding timelines a little bit longer than normal just because of that appreciation. I mean, there is such a thing as return on equity. And I think you need to be conscious reevaluating your portfolio every year are you in the best place? Are you investing in the best location for future appreciation? How are those properties performing? If there's a newer market that opens up that looks like it's in the path of progress and you want to participate there, what do? Do you sell those properties and 1031 them? Do you do a cash out refi or even put a potential HELOC on those to access that equity? All those options are on the table. I think it really depends where you're looking at. I will say, though, in general, what we've seen over this past 12 to 24 months, a lot of investors went into this wanting to hold these properties as long-term rentals, and they decided just to liquidate them. When you have six-figure type of equity positions, as many investors do in less than 18 months, it's pretty hard to say no to that. There's creative ways to do. Maybe the discussion is hold it for a year and then 1031 it. We're seeing about 50-50 with people just selling right out of the gates or actually holding for 3 to 5 years or potentially longer.
Oftentimes with renovated property, I've advocated that you as an investor, you really need to ask yourself if you want to hold on to that for more than 7 to 10 years. Because if you hold on to it for, say, 7 years and then sell a renovated property, well, you probably managed to avoid CapEx expenditures or probably wouldn't have been anything to do with the roof. A water heater is probably going to last that long. However, with these B2R properties, you oftentimes have different considerations that way.
Absolutely. Now, obviously, it's each person has their own individualistic goal, but to your point, there's always an optimal time, I think, to likely exit that property. And we see this a lot with newer investors is they have this idea that I want to own 30 properties and then have them free and clear and have $20,000 a month of passive income, whatever the case is. I think the reality, though, once they get investing and there's some properties that overperform and underperform, and you just need to reevaluate and see where you're at that point in time. Where is the market cycle? How is that performing? And always just be evaluating, does it make more sense to hold this property for another 3 to 4 years? Does it make sense to liquidate it now? That's an important thing to evaluate your portfolio, I think, on an annual basis. But definitely there's an optimal time where, yes, you've maximized your cash flow on the property. It's had some decent appreciation. The loan's being paid down a good amount. But once you creep up to that 10-year mark, maybe if you got to put a lot more money into it, that means you need to hold it another 5 to 10 years to recoup some of those benefits. But that's why it's always good to have that educational conversation with your investment advisors to see what do they think and what really makes most sense.
And part of it, to your point, is running that return on equity calculation. And you chose your word carefully and accurately, return on equity, because as I've often brought up, the return from equity is always zero. Oftentimes, after a good equity accumulation, yes, one can either sell that and just cash out and pay the tax, sell that and 1031 exchange it and defer that capital gains tax, or like I was just talking about on the prior episode, do a cash out refinance, which is incredible when you think about it. You get a lump sum chunk of cash flow is what some have called these cash out refinances. It's a tax-free event and you still get to hold onto the property. So that is the third of 3 primary exit strategies: outright sell into a 1031 exchange, or do a cash out refinance and hold on to the property. I've often stated that once you have 40% equity in a property, oftentimes that's when you want to take a look at it and evaluate things, because your leverage ratio has been cut from 5 to 1 if you made a 20% down payment down to 2.5 to 1 if you have 40% equity in it. And equity is running up fast. Someone might get 40% equity in a property if they started off with a 20% down payment in just 1 year in the environment that we're in today. So we're talking about your exit strategies for build to rents. Well, Zach, now that we've talked about build to rents kind of from the beginning and that construction process to the end, is there any last thing that a prospective investor should know about the build to rent market and investing today?
I think location is just a huge aspect of this. We've seen some build to rent spaces that are in lower income neighborhoods, and those are typically areas that we don't operate in. I very much like positioning a build to rent property in an area that's up and coming, maybe a middle B class area that, it still cash flows well, Keith, but you have a lot of government money and development and revitalization going on. So there's potential for even stronger future appreciation, areas where you potentially could use it as a short-term rental. versus your long-term rental, if that's an area that you're thinking about. But just being in the path of progress, generally there's a population shift, down to the Sun Belt. And there's some states right now that just have a huge housing shortage, and there's a wait list for renters and home buyers for the retail side. So those are the areas you want to be in. Make sure you're working with a reputable team. Just look at all your options and just take action, because if you don't, this market will pass you by. You'll be looking back thinking shoulda, coulda, woulda. But those that are taking action are definitely reaping the benefits right now, both in the investment space and the build to rent. Absolutely.
That's a great reminder. We've been talking about properties, and the market is more important than the property. A lot of investors don't realize that, or they tend to forget that. So it sure has been valuable talking about build to rent properties. Zach, thanks so much for coming on the show.
Thank you, Keith. It's been a pleasure.
Oh yeah, some good content from our guest on the pros and cons of using a construction loan with these new build rental properties. You sure don't have to go the construction loan route if you don't want to. There sure is so much potential equity to be made here now. And for this batch of properties that we were talking about, and it is an ongoing batch of constantly refreshing properties, go ahead and email our investment coach, Naresh. You not only get access to available properties, and these are single-family homes up to fourplexes and sometimes larger. They are existing build and new build. Some properties conducive to short-term rentals, though most are long-term rentals. Some really inexpensive properties, at times less than $150K, and those less expensive properties would tend to be existing renovated properties, not new ones. For access to all those property types and free coaching, contact Naresh. You can do that at Naresh at getricheducation.com. That's Naresh at getricheducation.com. Coming up here on the show next week for Milestone Episode 400, it is Miracle Morning author Hal Elrod and I discussing investor mindset and relationship building in real estate. Yes, it took longer than expected to get Hal and I together at the same time. That finally happens next week. And our operations lead here at GRE, Andrea, she's expected to be here with you and I for that show next week as well. And then the week after Hal Elrod, the international man, Doug Casey, joins us. When he was here last year, we discussed ideals like liberty and freedom. And this time it's going to be about economics. And yeah, it's usually pretty gloomy commentary with Doug, but he keeps it real. And then down the road, Rich Dad Tax Advisor Tom Wheelwright is back on the show with us yet again to help you cut your tax bill down toward zero. So with Hal Elrod, Doug Casey, and Tom Wheelwright coming up, I'd say that one inspires you, one depresses you, and one informs you. Hal being the inspiration, Doug being the source of the depression. And he knows that I kid about that. I was joking with Doug Casey about that last time. And then Tom Wheelwright being informative with seemingly some new tax plan that he has to tell you about. And then after that, negotiation expert Chris Voss returns to the show. You might have seen his masterclass course. So GRE is so stacked with great shows in the near future here. In inflationary times, there is no better place to invest than in real estate. I mean, consider this. Even if you bought a property all cash with no loan and you didn't have a tenant in it, real estate would be an inflation hedge just based on that alone, just based on its capital price tracking inflation. But then you get the leverage so you can 4x or 5x inflation while also having your debt debased by inflation while your tenant pays it down, and also while you have your cash flow outpace inflation because your biggest expense, the mortgage, stays fixed. So this is just one of so many reasons why real estate is what's made more ordinary people wealthy than anything else. So I really encourage you to get started. Not only do we have this still pretty new coaching service steeped in GRE principles, but it's also free, and we also have available properties. I encourage you to reach out to our friendly GRE investment coach, Naresh, at Naresh at getricheducation.com. Until next week for episode 400, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.